She paid double for everything and never even knew it. Rachel did everything right. She paid her bills on time, never went over her credit card limit, drove a used car, packed her lunch 3 days a week. That was the problem. Because every single month, Rachel paid double for things she did not even realize. Not double in one bill, double across dozens of small things. Things that looked normal. Things that looked smart. By the time she figured it out, she had lost $78,000 over 9 years. Not because she was careless, because nobody told her how the system actually works. Meet Rachel. That was not a gambling loss. That was not a shopping spree. That was just normal life. The biggest mistake Rachel made was not the car loan or the mortgage. It was something much smaller. We will get to that. Today, we are going to show you exactly what Rachel did. And more importantly, how you can stop doing the same thing starting this week. Let us start with the first place Rachel bled money every month without knowing it. Rachel had a car loan. She got it at a dealership 5 years ago. The rate was 6.9%. She thought that was fine because the salesperson said most people get 7 or 8%, so she was doing well. What Rachel did not know is that her credit score at the time qualified her for 3.9% at her local credit union. That difference does not sound like much. But on a $22,000 loan over 5 years, the difference between 3.9 and 6.9% is $2,340 in extra interest paid. That is not a fee. That is not a penalty. That is just money Rachel handed over because she did not shop around for 30 minutes. According to the Consumer Financial Protection Bureau, borrowers who get pre-approved at a bank or credit union before going to a dealership save an average of $1,000 to $2,000 on auto loan interest costs. Rachel never got pre-approved. She trusted the dealer. That is where the first leak started. Rachel also had a mortgage. And this is where things get painful. She bought her house in 2017 at a fixed rate of 4.5%. Fine, normal, not her mistake. Her mistake came in 2020 when rates dropped to historic lows, around 2.75% according to Freddie Mac data. Her neighbor refinanced, saved around $210 per month. Over 10 years, that is $25,200. Rachel did not refinance, not because she could not, because no one told her to, and she assumed her bank would contact her if it made sense. Rates are not at those lows today, but the lesson is permanent. When rates drop significantly compared to what you locked in, refinancing saves thousands. Most people never check. They assume someone will tell them. No one will. Rachel never questioned it. Most people never do. Now, if you want to keep learning things like this every single week, hit that subscribe button right now. We break down exactly how money actually works so you can keep more of yours. New episode every week, free. Now, let us talk about insurance. Rachel had the same car insurance company for 9 years. She never switched. She paid automatically. She assumed loyalty would save her money. Wrong. The National Association of Insurance Commissioners has documented what the industry calls price optimization. This is when insurers quietly raise premiums for customers who are unlikely to shop around, not because your risk changed, because they know you will not leave. Policyholders who switch insurance providers save an average of $500 to $700 per year, according to data from the Insurance Information Institute. Rachel spent 9 years loyal to a company that was charging her for that loyalty. That is potentially $6,300 over those 9 years. She also had a life insurance policy she bought in her 20s, a whole life policy. Her agent at the time said it was the smart long-term choice because it builds cash value. Here is what Rachel did not know. For the vast majority of families, term life insurance is the smarter choice. The fees inside whole life policies eat up a massive portion of your early cash value growth. In very specific situations like high net worth estate planning, whole life has a purpose. But for most working Americans, a 20-year term policy would have cost Rachel roughly half what she was paying every single month. The rest could have gone into a low-cost index fund and actually grown. According to LIMRA, which tracks insurance industry data, most Americans who own whole life policies do not fully understand the fee structure inside them. Rachel was one of those Americans. Let us talk about Rachel at the grocery store. Rachel was not reckless. She did not buy fancy brands for everything, but she had habits. She bought name brand ibuprofen, name brand antacids, name brand allergy medication. The FDA requires that generic medications have the same active ingredient at the same dosage and the same effectiveness as brand name versions. This is not a debate. This is federal law. A bottle of 200 generic ibuprofen costs around $4. The same count of Advil costs around $13. If Rachel bought just 4 of these types of products per month at brand name prices versus generic, she was spending an extra $30 to $40 monthly. That is $360 to $480 per year on nothing. Literally nothing different in the bottle. That same principle hits in other places. Store brand pasta, store brand canned tomatoes, store brand cleaning products. Studies from Consumer Reports show that generic and store brand products perform identically to name brand products in the majority of tested categories. Rachel paid for the label. The label did not feed her better, it just felt safer. Now here is the one that gets almost every American. Bank fees. Rachel had a checking account she opened in college. She never switched. $8 a month in maintenance fees. $3 every time she used an out-of-network ATM. 3 times a month. That is $14 a month. $168 a year. Over 9 years, that is $1,512. Gone. Not spent on anything. Just fees for the privilege of storing her own money somewhere. The FDIC reports that the average monthly maintenance fee on checking accounts at large banks is $15.33. Meanwhile, thousands of credit unions and online banks offer free checking with no minimums. Rachel had never even looked. She assumed all banks were basically the same. They are not. Let us talk about subscriptions. A 2024 survey by C+R Research found that the average American spends $329 per month on subscriptions. When that same group was asked to estimate their subscription spending, they guessed around $86. The gap between what people actually pay and what they think they pay is massive. Rachel had streaming services she forgot she signed up for. A gym membership she used twice after January. A meal kit subscription she paused and then forgot to cancel. A cloud storage plan she was paying for on 2 devices, a music service and a podcast service and an audiobook service with overlapping features. This is not about being irresponsible. It is about how subscription services are engineered. They are designed to be easy to start and invisible once running. The business model depends on what the industry calls passive churn. That is customers who forgot they subscribed, still paying every month. Rachel was funding that model with around $110 per month in forgotten or underused subscriptions. That is $1,320 per year. Here is one Rachel never expected. Her savings account was also costing her money, not in fees, in opportunity cost. Rachel kept $12,000 in an emergency fund at a major bank. Her interest rate was 0.01%. She earned around $1.20 per year on $12,000. In recent years, high-yield savings accounts at FDIC insured online banks have been offering 4 to 5%. On $12,000 at 5%, that is $600 per year in interest she could have earned. She earned $1. Over just 2 years, Rachel missed $1,200 in safe low risk guaranteed interest because she never moved her savings account. According to Bankrate data, the national average savings rate at big banks sits around 0.58%, while top high-yield accounts are over 10 times that. Rachel did not need to take any risk. She just needed to move her money to a different FDIC-insured account. She never did. We are almost done. But this last one is the biggest of all. Remember the open loop from the beginning? The mistake that was smaller than the car loan and the mortgage? This is it. Rachel had access to a 401k at her job. Her employer matched contributions up to 4% of her salary. Rachel contributed 2% because that felt affordable at the time, and she never changed it. She left 4% of her salary in free money on the table every single year for 7 years. Rachel made $58,000 per year on average during that period. 4% is $2,320 per year in employer contributions she never received. Over 7 years with average market growth, that unclaimed free money could have grown to over $25,000 sitting in her retirement account right now. Vanguard research consistently shows that one of the most common 401k mistakes is under contributing and missing the full employer match. This is not a complex investment strategy. This is free compensation that requires only one form to be updated with HR. Rachel filled out her original 401k enrollment form in her first week. She never looked at it again. She never questioned it. Most people never do. Here is the total. Auto loan overpayment from not rate shopping, $2,300. Missed refinance savings, $25,200. Insurance loyalty penalty over 9 years, $6,300. Whole life versus term insurance gap, approximately $4,000. Generic versus brand name products, $3,600. Bank fees, $1,500. Forgotten subscriptions, $9,240. Lost high-yield savings interest, $1,200. Missed 401k employer match, $25,000. Total, $78,340. Not from gambling, not from luxury, not from recklessness, from not knowing how systems work. Rachel is not the villain in this story. The financial system profits from people who do not know what they do not know. The insurance model, the bank fee model, the subscription model, the dealer financing model. All of it runs on autopilot and assumption. But now you know. Rate shop every loan before you sign. Refinance when rates drop meaningfully below what you locked in. Switch insurance every 1 to 2 years or negotiate. Review subscriptions every quarter. Move your savings to a high-yield FDIC-insured account this week. Contribute at minimum whatever your employer will match. Choose generic. Choose credit unions. Not all at once. Pick one this week. Then another next week. Rachel eventually figured this out. It cost her $78,000 in tuition. Your tuition just cost you the time it took to watch this video. If this opened your eyes, share it with one person who needs to hear it. And if you are not subscribed yet, that button is right there. Every week, we break down exactly how money actually works so you can keep more of yours. Until next time, keep your eyes open. The system is always running. Make sure it is running for you.